Okay, here we're continuing our discussion of ARC Section 80 as it relates to the compilation of financial statements. And in the last several videos, we've been talking about our accountant's compilation report and what are some of the requirements for including in the compilation report, and also any alterations that we needed to make if we're, for instance, not independent of the entity, or if the entity used a special purpose framework in preparing its financial statements. And so now we are going to discuss what changes to the compilation report do we need to make if the entity elected to omit substantially all of its disclosures required by the financial reporting framework. Okay, and so first we see that the significant assumptions that are included in the disclosures are an essential part of prospective financial information. So to make sure we understand, here we're talking about prospective information or pro forma information. So if there aren't disclosures that discuss the assumptions and predicting the future financial information, then we should not issue a compilation report related to that. And also regarding if we're performing a compilation on financial projections and those exclude the identification of the hypothetical assumptions or a description of the limitations on the usefulness of the presentation, then we should not issue a compilation report on that. But having said that, if the client does include these types of disclosures, the assumptions and limitations, then in our compilation report, when we issue it, we're required to include in it a phrase that the forecast or the projections may not be achieved, and that we don't assume any responsibility to update the report for any events or circumstances that occur after the date of the report. And so this is in relation to if we're providing a compilation on prospective financial information. However, if we're preparing a compilation for historic financial information, we'll discuss the requirements here for when they omit substantially all disclosures. And so if they elect to omit substantially all disclosures on historical financial statements, then we're allowed to issue our compilation report if, to our knowledge, their decision to omit substantially all disclosures wasn't undertaken in order to mislead the users of the financial statement. And so if we find that management has elected to omit substantially all of the disclosures and that wasn't undertaken to mislead the users of the financials, then we can issue our compilation report. We just have to disclose that all of the footnotes and disclosures have been omitted, which is essentially a departure from the financial reporting framework. So we should include in our compilation report a statement that management has elected to omit substantially all disclosures, and the statement of cash flows if they elected to omit the statement of cash flows. And those disclosures were required by the applicable financial reporting framework. Or if they were prepared in accordance with a special purpose framework, then we would say something to the effect of that those disclosures are normally included with the financial statements. So in addition to that, we have to include a statement that says the omitted disclosures, or rather that if the omitted disclosures were included in the financial statements, they might influence the user's conclusions about the entity's financial position, the results of operations, and cash flows. And finally, we include a statement that says the financial statements are not designed for those who are not informed about the matters that might have been included in the disclosures that were omitted. So in summary, if management elected to omit substantially all the disclosures, we can still issue the compilation report. However, in our compilation report, we need to say that all the disclosures were omitted, and that if they had been included, users might have some different information that might sway their conclusions about the financial statements, and also the user should be informed about what would have been included in the disclosures for them to fully understand the financial results and financial position of the company. And so if management only elected to omit a couple of footnotes or disclosures that are normally included with the disclosures in the financial statements, then we treat that the same way we would as a departure from the applicable financial reporting framework. And we'll get into that in the next video. But in that case, we wouldn't include any of these disclosures in our compilation report, where we say they omitted substantially all disclosures, because they didn't. They only omitted a few of those. So in the next video, we'll look at how we can disclose that situation. And down here in the explanatory material, as it relates to our accountant's compilation report, when the management decides to omit substantially all the disclosures that are required by the financial reporting framework, then it says here that we can also, or rather, if management decides to include a few disclosures, but to omit substantially all of the other ones, then our title in the notes to the financial statements might say something like, selected information, substantially all disclosures required by, for instance, GAAP, are not included. So with this, we generally have three different ways of dealing with whether or not the disclosures are included in the financial statements. Option one is that they do include all of the disclosures, and for that we don't mention it at all in our accountant's compilation report. Option two is that they include all of the required disclosures except a few, and in that case, that would be a departure from the financial reporting framework and would be governed by the next section, ARC section 98.29 through 33, which we'll get to in a subsequent video. And the third option would be this one, where the management decides to include only a few disclosures and to omit substantially all of the other required disclosures. And in that case, we would still include in our accountant's compilation report that they omitted substantially all of the disclosures. And in the footnote section of the financial statements, we would include this title to make note that management decided to disclose these particular items that they selected to disclose. So fortunately for us, we have a few examples of how we might alter our accountant's compilation report based on if management elected to omit substantially all the disclosures. And that illustrative example is down in Exhibit B. We've already looked at a few examples for other situations where we might alter the compilation report, but let's look at the examples that relate to the omitted disclosures. Okay, now we're in Exhibit B, where we have some illustrative examples, and we've seen a few of these before, but this is illustrations 1 through 6. And for this particular video, we'll take a look at illustration 3, because this one shows us how the accountant's compilation report was altered or prepared when management elected to omit substantially all disclosures. And in this case, the financial statements were prepared in accordance with the tax basis of accounting, and so they elected to omit all of the disclosures that are usually included under tax basis of accounting, and this could very well be GAAP or some other basis of accounting. So let's go down and take a look at illustration 3 to see the disclosures they included to notify the users of the financial statements that the disclosures were omitted. So we see here that we have this paragraph here. Everything else was similar to what we've seen before, but they've included this paragraph. And it says that management has elected to omit substantially all the disclosures ordinarily included in the financial statements that are prepared in accordance with the tax basis of accounting, and that if the omitted disclosures were included in the financial statements, then they might influence the user's conclusions about the company's assets, liabilities, equity, revenue, and expenses. And accordingly, the financial statements are not designed for those who are not informed about such matters. So remember, these are the three requirements that said omit substantially all disclosures. If they had been included, users' conclusions might have been changed, and that the users should be informed about what would have been included in the disclosures to have a full understanding of what happened in the year. So this is a good example, and if it turns out the client omitted all of its disclosures, then we would include this paragraph in our accountant's compilation report.